Hello, I'm Michelle Makori, and thank you for joining this very special episode of On the Spot, coming to you from Tampa, Florida, from the headquarters of the Verified Investing team. And I'm thrilled to be here with the Gareth Soloway, Chief Market Strategist at Verified Investing. Fabulous to be here in sunny Florida.
I am thrilled to have you here in sunny Florida. It is an amazing place. The weather is amazing, and the market discussion we're going to have today, I'm sure, is going to be amazing.
And what a fortuitous time to be here. What a great day. Bitcoin and gold both hitting new all-time highs today. Timing is extraordinary, and we're definitely going to dig deep into that. Let's start off, though, Gareth, with the overall picture of what we have today, because we had gold hitting a new all-time high, gold seen traditionally as a safe haven, a risk-off asset, at the same time as Bitcoin, which is really seen as a riskier, more volatile asset, even though the Bitcoiners like to have it positioned as a safe haven store of value asset, still very much seen as a risk-on trade, both hitting new all-time highs on the same day. What do you make of that?
Yeah, so I think it's a couple things. Number one, there's a risk-on environment in the markets that's driving Bitcoin, right? So we've seen NVIDIA, SMCI, the stock market making new all-time highs. In fact, the NASDAQ's been really running, but we've seen a lot of the other sectors in the S&P lagging technology. So there's this risk-on environment getting into the highest risk type plays. That's been driving the stock market and Bitcoin with money flow. There's been excitement about the spot ETF and these inflows and getting everyone involved. The talk has been kind of contributing to this GameStop AMC type run in this asset. And then you have gold on the other side, where you basically have had the central banks loading the boat for a long period of time, which is why gold hasn't pulled back from the all-time highs very far, right? So if you look at a normal market situation, when you have the VIX as low as it is, stock markets at all-time highs, Bitcoin's at all-time highs, gold should be down 10, 15, 20% from its all-time highs. And instead it was down 1% to 2% over the last couple weeks until it got this one little push. And I'm convinced that smart money is at a point here where they're starting to say, this is a bubble in these risk assets. And therefore they're rotating in. You got the breakout, you got the momentum kicking in now on gold. And that's again explaining why both assets have pushed to new all-time highs. But I do think, and I'll say this here, is that Bitcoin is at risk if the stock market sells off. And this has been one of my theses for a long time. If the stock market sells off dramatically, Bitcoin comes in dramatic as well.
Okay, it's interesting that you make the distinction between the smart money going into Bitcoin right at the same time as what they call the dumb money. The retail investors have access, or going into gold rather, right at the same time as the dumb money or the retail investors have access to Bitcoin.
Right. Right. I mean, and listen, every money is valid. I don't want to discriminate here at all. But you have the institutions and the central banks that have been, and there's data on this, they have been buying gold hand over fist. And it always drives me nuts when people are like, oh, well, gold is not important anymore. Yet the central banks, the ones that print all of the money out there, the Federal Reserve, the Bank of Japan, all of these players that have their finger on that printing press, they're the ones buying the most gold. That's really the smart money. Institutions like, hedge funds, not so much smart. They're included with everyone else, and they're running after Bitcoin. They're running after stocks. They're paying ridiculous amounts for NVIDIA, SMCI, and that's the difference maker here. But it didn't take much to push gold over that threshold.
Right.
And now you have an asset that is so underinvested by retail that they're now having to play catch up. And this is just the start of gold and gold miners.
Okay, we're going to dig deep into gold. But before we do that, let's focus on Bitcoin and the moves that we saw today, because we had Bitcoin soaring past that 69,000 high that it hit in November of 2021, reaching about 69,320, give or take, based on Coinbase. Then we saw quite a dramatic pullback of about 14%, and Bitcoin settling at around 63,000 as we speak.
Yeah.
Talk us through that move that we saw today.
So what you saw was this culmination of greed, right? And again, people chasing a move that was already up. I mean, just looking at the last week, we're up from 50,000. We got that breakout above the spot ETF level of 49,000. And the momentum of that carried it up to this all-time high. But it's also known as a technical double top. And at double top, there's notoriously going to be players that are selling into that level or shorting it. And when you get to this point of euphoria, it gets every last buyer in, so that when those sellers and shorters start pounding it down, there's no one left to buy. And that's where you get these dramatic drops. In addition, it's accelerated by the leverage in the crypto markets, right? I mean, in the stock market, you can play 2-to-1. 2-to-1 leverage is what an overnight investor can hold in a regular account. In crypto, it can be up to 100. It can be higher than that. And that creates these pockets where when flushes occur, you get these massive moves to the downside. And I would just like to say this, is that if you want the mom and pops that are not in, the people that people hope start to buy into, the pension funds to buy into Bitcoin, you can't have intraday moves of 10 to 15%. They do not want to be involved in that. So this type of move is not healthy for crypto.
Well, that's debatable, whether that maybe pulls in more people that want that great return that you can make on, but we'll get into that. Let's focus on what we're seeing from the technicals right now, because in past cycles, and granted there haven't been that many, but in past cycles, Bitcoin typically doubles after hitting a new high. That's what we've seen. Anthony Pompeo was making similar comments that that's what we should be expecting in this cycle. What do the charts tell us? Where do you see the next line of resistance here?
Yeah, so first off, we have to be aware that the double top is the double top. So on a technical basis, until we really clear that, and a pierce intraday doesn't matter so much. So it's obviously we pierced it. It kind of stopped out a lot of people that probably had their stops right at 69,000, that former high. We pierced it, and then you saw the flush back down. Now, if we can establish ourselves over 69,000, I do think you have a shot at 100,000 here on Bitcoin. But again, it's a big if. It has to be if risk stays in play, essentially. Meaning that if we start seeing the Fed not going to cut rates, if we start to see less liquidity in the system because they're doing away with some of these bank funding programs, that's going to hurt Bitcoin just like the stock market.
Well, speaking of the stock market, I mean, we had this new all-time high reached on a day that we did see quite a small, but a pullback in the S&P and in the NASDAQ. The Magnificent Seven, none of them looked that magnificent today. Yes, we had Bitcoin pull back, but it did reach its all-time high earlier today. Are we seeing a decorrelation between Bitcoin and the NASDAQ, or do you still see that correlation as pretty tight?
No, I still see that correlation as pretty tight, and I think that's partially what we saw today. Is what we saw is the stock market coming down. There's still all this excitement over what we're hearing about all these inflows into these ETFs, record inflows, and it kind of creates this angst to get in. People have to rush in regardless of price, right? I mean, price could have been 100,000, a million. People were still going to get in.
That FOMO kicks in, Gareth.
FOMO, that's what it is, right? And then what happened was people started to realize also that the stock market was coming down, and we saw this big reversal in Bitcoin. So I really do think it's still a risk asset. Now, over the next 10 to 20 years, I think it moves more towards the digital gold, which is actually a very healthy thing for it to do. It's just not there. And again, if you could line up a chart of NVIDIA over the last couple months with Bitcoin, they are almost identical.
All right. One of the calls that you had correctly was that you expected a buy on the rumor, sell on the news event with regards to the spot Bitcoin ETFs. Now, we did get that last time we spoke, which was right after the approval of the spot Bitcoin ETFs. We saw Bitcoin move to about 48,000, 49,000 on that news, got stuck, and then we had a retracement back to 38,000 as, I guess, some profit taking at that level. At the time, you said that you thought it would be quite likely that we could see a pullback to 32,000.
Right.
If we started to see the market cool off.
Right.
You got a bit of flack for that call.
Right.
But you did caveat it with an if we start to see the market cool off. And of course, then we had those NVIDIA earnings, which blew past expectations and saw, the S&P hitting a new all-time high. So where are we now? What is your outlook in terms of what kind of retracement we can see with this current condition? So
just purely based on the charts, if we get a significant pullback here in Bitcoin, the 49 to 50,000 level is now major support. So again, that would be just your run of the mill correction. And the reason that's significant is because that was the previous spot ETF high. So we ran up to 49, we pulled back, like you said, to the high 30s, and then we went up and broke out. So resistance, once we broke above 49, resistance becomes technical support. So on the way down now, 49 to 50 becomes huge support. Now, I will say this. If the stock market begins to crumble, let's say all of a sudden it becomes a risk-off environment, then we most likely will go down to that 30 to 32,000 level.
Right. Okay, but for now, you're ready to call a strong bottom at 49.50 or a strong level
as long as the stock market stays strong, which again is all tied to liquidity from our good old-fashioned government printing money, and I know we'll get into that, and the Federal Reserve. then to be honest, pullbacks are buying opportunities in Bitcoin, and 49 to 50 is a major support.
How likely is it that you think we get a pullback to that now, especially considering we've got the halving coming up in April?
Yeah.
Which is traditionally, bullish because we have fewer rewards for miners, reduced supply, and we're going to have all this increase in demand with the spot Bitcoin ETFs. So can we expect a pullback? What are you seeing right now then?
Yeah, so I think honestly, if we see the NASDAQ and the S&P continue to make new all-time highs, the pullbacks will be unbelievably small. Like today, honestly, the low, if we see another new all-time high in the next couple days in the S&P, today's low is probably the low, and we're going above that 69,000 level. It's only if we start to see a little breakdown. So like a 10% correction in the stock market, that takes us back to 49 to 50,000. We get a 30% correction in the stock market, we're back to 30 to 32,000. A 50% correction in the stock market, a la, something like the Great Recession. Now you're talking about potentially revisiting the 15 to 20,000 range. So that is a possibility. But again, think about the environment. We've been programmed. The Fed has programmed that they will be always there to inject some good old-fashioned drugs into the markets to just get this market going. If we see inflation not coming down any further and it starts to uptick and we go into a recession, what's the Fed going to do? They can't do anything. I mean, yeah, they'll print, but you know what it's going to do? It's going to spike inflation back north of 9%, probably to 15%. And there's going to be a whole new catastrophic situation, right? Probably even stagflation. So I know we're getting ahead of it in terms of what you want to discuss, but I just get excited about this stuff. And it's just like people have to realize that this is a house of cards that will collapse.
But the sentiment seems to be that the Fed put is back on.
Yeah.
That the Fed will step in.
Right, because inflation's come down, right? So as long as we see that inflation coming back inside of that Pandora's box, then sure, then the Fed can come out and print their money crazy again and do everything they did by lowering rates to near zero. But my thesis is that you have government spending that just keeps going up. I mean, every, $1 trillion, every 100 days added to the national debt. How long is that sustainable? Now, if rates are staying, let's say now they're projecting rates on the Fed funds watch tool, it's only going to be in a year, it's going to be down to about 4%. Okay, so now you're refinancing all the U.S. debt that's coming due at 4% versus at 1 or 2% where it was. I mean, there's massive spending that is going to have to continue. And the only way the government gets control of that is by basically doing austerity, which is what they did in Europe back, I think it was like the 2013, 2015 period. And to do that, you're going to force the U.S. into a horrendous recession. So pick your poison. It's either the U.S. debt is going to continue to soar towards 100 trillion, or we can go into basically what's close to a Great Depression.
Right, but it seems as though they've avoided that and continue to kick that particular can down the road and down the road and down the road. And everybody's been saying, any day now, it's going to happen. But the consequences for that don't seem to materialize. It seems
not yet, right? I mean,
but so let's talk a little bit more short term, because I get that big picture. That is a huge concern. But more short term, I mean, is it likely that you are anticipating a 50% pullback in the S&P 500?
I do think, yeah, absolutely. In fact, think about this. The NASDAQ is up just from the October 2022 lows. What is it up, 67%? So, I mean, just a 50% correction takes us back to that level about. I mean, it's not that outlandish to think that and again, keep in mind, we're slowly losing. Like if you look at the Magnificent Seven, one by one, they're dropping off the cliff. Apple's dropped off the cliff and it's had a major breakdown. We've seen even Microsoft now today was down significantly just after making new all-time highs. Tesla's getting crushed over the last 12 months. And so slowly these stocks are starting to collapse. Then we look at all the sectors. Out of the 11 sectors of the S&P 500, there's only one sector that has made a new all-time high. So the pieces of the puzzle of something bigger are there. It's being masked by liquidity that supposedly the Fed was supposed to suck out, and they didn't, with these loan programs, emergency loan programs to the banks and all these other things. And then you also have the government that's making up for the balance sheet. And again, this is another amazing stat. The Fed balance sheet's gone down by $1.5 trillion. That's it. The U.S. deficit in that same time has added like 6 to 7 trillion. And you have to understand, people, when we borrow money from other countries, the U.S. is spending that money, which is stimulating the economy. And so it's just pumping more and more liquidity into the system. So you're right. This is a long picture thing, as we don't know when it's going to happen, but we are a lot closer than people realize, inclusive of a 100-year cycle. I don't want to get into cycle work at this point too much because it gets a little bit more complex, but think about COVID, think about Spanish flu, 100-year cycle. We're coming right up to the Great Depression 100-year cycle as well.
Yes, and we've had a number of guests on Kitco warn about this,
Yep.
warn that a turning point is
And
imminent.
it hasn't materialized, I know.
Is imminent. But, you know, we get accused of being too bearish.
Right, fear-mongering, all this stuff, yes.
I believe fear porn is the term
Yes.
used on our headlines. Why are you so negative if the indications are, I mean, yes, the government data is starting to turn a little bit, but the big institutions on Wall Street, just to
Right.
play devil's advocate here, right?
Right.
They're all projecting a soft landing,
Right.
right? Everybody has turned a more optimistic note for what we can expect for the markets this year.
Which, by the way, that happened in 2007, too. That happened in 1999 to 2000.
So that in itself is a contraindication.
It is. It absolutely is, because what happens is so there's two ways to look at it. One is that these bank players are humans just like everyone, and they get emotional and they feel like they're missing out. And these analysts are like, oh my gosh, if I don't upgrade this market and my target is too bearish, I'm going to get fired from my job for not being on top of this move. Or you could say the big banks, the big institutions are looking for exit liquidity. Right? Exit liquidity, meaning that they have these massive positions that they need to unload. Now, again, I don't want to be accusing anyone of anything here. I'm just saying that there's two ways to look at this. One is it's either they're human or it's exit liquidity, because it's way too common that these massive upgrades to stocks come in at massive tops, and same thing to the stock market, right? And again, just look at this chart right here. This is the U6 employment thing. One of the things I found in this chart is that U6 starts upticking 12 months before a recession. If you look back here, 12 months, we had a recession. 12 months, we had a recession. And if you look at the latest here, we have an uptick of U6 for the last almost 12 months. It's about 9 months now. Now, interestingly enough, if you overlay unemployment on this, what we see is unemployment is still low all of these times until we actually get to the recession.
What is the U6 chart specifically?
So just to explain, and that's a great question, U6 is underemployed. So
Okay.
people that, let's say you're working at a job and the job comes to you and says, listen, I don't really want to fire you because maybe the economy will get better. Maybe Biden is going to really come through, or Trump will get in the presidency and things will be good. I don't want to struggle to find someone who, you know, as hard as it was to find people to hire, I don't want to find someone again. So let me just cut back your hours a little bit, and hopefully we'll put you back to full time in a little bit. That's the beginnings of a recession. That's the sign, right? Or someone else, let's say you're looking for a job and the only thing you can find is part-time. And one of the stats we've seen is people are taking multiple part-time jobs to make ends meet because inflation has gone nuts. And so all of these things are in this U6, and it's kind of a leading indicator. So eventually what happens is businesses say, wow, the economy's not turning around. So we do actually have to lay you off. I'm sorry, we have to lay you off. And that's where you start getting that unemployment number to actually spike up. But if you're underemployed, you're technically not unemployed. And that's what the U6 is telling us.
And I agree that there is a seeming disconnect between what we've seen in the markets, what we've seen according to the official government data, and what people are sensing at home. And it's not just sensing, it's not just feelings, it's you going to the grocery store,
Right.
your bill is higher, there is an increased sense of pessimism. You're just feeling like your dollar isn't going as far as it used to.
Right.
And that's a very tangible concern. But before we get further into the big macro picture, I want to bring it back to Bitcoin.
Okay.
Right? And we do still have a potentially positive event, the halving, right? We still have a lot of retail investors catching into the FOMO trade, seeing, you know, Bitcoin's become a mainstream news topic now. Everybody's talking about Bitcoin again.
Yeah.
What do you think that means for the price come May? Now, I understand big picture. If we have a 50% correction, Bitcoin retraces to 15. But we're not going to likely have a 50% correction by May.
No, definitely
But we
not.
do have the halving. What's your outlook? And I know you're a swing trader, but what's your outlook for May?
So Bitcoin itself, with the halving, it's going to continue to keep the hype going. And so I would be very skeptical that we will see anything bigger than a pullback to about that 49 to 50,000 level.
That's still a huge pullback.
Yeah, but keep in mind, today we were at 69 and we went to 59. So, Bitcoin's pullbacks are the equivalent of Apple moving like 2%, right, in a day. That's a big move for Apple. Bitcoin moves 10% in a day. That's the equivalent. So I think you have to just be aware of that, yes, it's a big pullback in percentage terms, but it's not outlandish for what Bitcoin does on a normal basis.
What do you expect to see in terms of hodling mentality, right? A lot of the Bitcoin is a traditional Bitcoin is
Right.
diamond hands, hodl, hold on for dear life. Now you've got Bitcoin becoming more of a mainstream asset. Wall Street coming in, more likely to have traders looking to take profits in and out, move in and out of positions. Personally, I buy, I hold, I never sell. That's just my Bitcoin philosophy. But we have it now as a bigger, more standard Wall Street asset. Does that mean we're going to have more volatility, less volatility, keeping in mind that prior to this, we had a couple of big whales that basically influenced the market, and a tweet from a whale could send the price going by huge amounts one way or the other. So with Bitcoin becoming more of a Wall Street mainstream asset, what does that mean for volatility and price moves?
So the more players that get in and the more institutional investors that get in, the less they'll get shaken out by whipsaw in the market. So I know we know that there's a lot of hodlers out there that just want to hold on, but a lot of those hodlers are smaller players that are just holding, less than a Bitcoin or one Bitcoin. And those are the types of mentalities that they can get swayed very easily by big news that either makes them overly bullish and buy in at highs or actually exit at lows. As you draw in, and the good example would be Apple or Microsoft, the more big money that gets involved, the less likely they'll get shaken out on hype, essentially. And so what we should see is Bitcoin gets less and less volatile over time. And this is where you kind of think about it as my bullish case for Bitcoin over the longer time, where it starts to behave more and more like gold. Now, it's not going to be great for the traders and stuff like that, but for people that actually believe that you need an alternative to the US currency or to just fiat currencies, this is exactly where we want it to go.
And that potentially is also the reason that we see both gold and Bitcoin reaching new all-time highs as an anti-fiat play,
absolutely,
as a reaction to $34 trillion
I totally
in debt.
think that it is partially tied to the fact that we just hear these crazy numbers like, oh, the U.S. government just added another $100 billion in debt in the last few days or whatever it is. There's no doubt that people are continuing to be concerned. In fact, it's one of the top concerns going into this election cycle about the U.S. debt. My only issue is, and this is what I've said to people, is like, people have to understand you can't have your cake and eat it too. We can get the U.S. debt under control. The government can stop spending ridiculous amounts of money. I think we should have a balanced budget. That should be written in in the Constitution, that you always have to have a balanced budget, but it will come with austerity, which is going to be painful for people. It's going to mean higher taxes. It's going to mean, there's a lot of things that it's going to mean, and people just have to be accepting of that. It's like you can't have the greatest of times, the greatest economic growth, like over the last 20, 30, whatever years, and then not pay for it in some form. Eventually that bill comes due.
Granted, we just said that some of the movement in Bitcoin is a reaction to devaluing and debasement of fiat currency. And I would say that is for the more sophisticated investor that's aware of it. Respectfully, you do now have people that are just seeing these Bitcoin headlines and they say, get me in through the spot Bitcoin ETF. And that's not really a narrative that's moving anything for them.
Right.
Again, I didn't get a straight answer for you from where you see Bitcoin at the end of May.
Well, I said a pullback to 49 to 50,000.
49. You believe that
by the end of May, I think we could see that, yeah. And I wouldn't even be surprised if it's come sooner, considering we already dipped. Like, think about from 69 today down to 59. Now we're back to 50 to 63. But I mean, if you let's just say we get your run-of-the-mill 3 to 4% pullback in the stock market, easily that could pull us back on Bitcoin. And people have to realize also that the inflows into ETFs are something that's great. It pushes extra Bitcoin upside, but it also, like, if people got in and all of a sudden they saw this volatility today and they're like, wait a minute, I didn't realize Bitcoin could move 14% in a day. I got to sell my ETF. The ETFs then have to sell Bitcoin. So it works both ways. And any sort of drawdown in the stock market will have a short-term impact on Bitcoin. Maybe not a long-term, but short-term impact.
You don't think that people going into Bitcoin, even via an ETF, are aware that this is a very volatile asset? I mean, I would think that they've already calculated in their mind that this asset moves like no other and should be used to the stomach churning of 14% in a day.
I think the investor that's buying in at 65 to 69,000 like today is thinking, holy cow, I'm going to make so much money. Tomorrow it'll be 75, then it'll be 90. They're not thinking about the downside. It's when they see that red in their portfolio that they start to say, oh crap, this goes both ways. But I'm telling you, investors, and I've dealt with them for 25 years now, everyone goes into a trade thinking, I'm going to become a millionaire. This is going to be the easiest trade of my life. And then, oops, not so easy.
All right, so 49 to 50K in May.
Let's do it.
An opportunity to pick up more Bitcoin.
That's right. There you go.
But again, big picture, where do you see Bitcoin then at the end of the year?
End of the year, my guess is if
And that's not a big picture. That's a small picture,
right.
actually.
Let's just say end of year into next year. If we do get a recession, which I do believe that we will be in a recession at some time in the second half of this year, as the metrics are continuing to show, I do think that you will see Bitcoin below 50 and 49,000 back to 30 to 32.
So basically, you're saying that you don't think we're going to really hit beyond this 69,324, give or take, that we saw today. Is what you're
No, I mean, you could. I think you could pierce 70. You could maybe make one more attempt at it, but for the most part, I do think that we're closer to the highs right now, at least in this portion of the cycle. I think the only chance you have here is the hype of the halving, and if the halving if we can get to the halving without a major market correction, then we could go a little higher. Other than that, I think once the halving's over, you get a correction just based on the hype. I mean, think about it. We've gone from spot ETF to halving. What's next? What's the next narrative that they're going to spin? That's the question.
Well, just continued inflows.
Yeah. But again, it's not as sexy as like, oh, it's the halving, or like, oh, it's the spot ETF approval. There's, again, it's the way humans work, is this mentality, this emotional attachment where they rush into things because there's a story to tell, right? We're very much into stories in our life. We watch the news, we watch social media, we watch all these things. And once that's over, there'll be a sell the news event, much like what we saw with the spot ETF, that'll probably take us down 20%, maybe more.
Okay, so you think it's more likely that we go back to 49 and potentially even 15 than it is that...
Again, please let's keep in mind, because I'll get added on Twitter and every other social. The key is, again, and I say this super clear because people always take the one headline but not the other, is that the only way we're ever going back to 15,000 is if we get a massive correction of over 15% in the stock market.
50%. 50 equals 1.5 in Bitcoin.
That's right.
Okay. All right, and 49 in May, and you think 70 is about as high as we're going to get for 2024?
I do.
Okay. Well, many would disagree with you,
absolutely,
Gareth, but that's
what makes a market.
That is exactly what makes a market and keeps things interesting and exciting. And again, I always like to point out that for those calling you a perma-bear, you're a swing trader, you're a day trader, you make money on the daily moves.
Yeah.
But I know that big picture, you're still very bullish on Bitcoin.
Yeah, there's no doubt. I mean, again, since 2013, when I really started to get interested in Bitcoin, and if only I had loaded the boat back then, right? There's always the what ifs. But, I got interested because I saw what was going on in the government. It was already a dysfunctional government back then. It's only gotten worse. It's all about, can I get reelected in the next 4 years, in the next whatever years? And it's all based on, well, then we have to spend money here. We have to do a pet project here to just get all of these things going, which just runs up the debt. No one's looking at the long term. And when you focus on the short term, right, it's like, think about it like this, on my body, right? I could take steroids and get in crazy shape, but obviously that's got repercussions in the long run. Mm-hmm. And you have to look at the long run. And politicians don't look at the long run. All they care about is what's good for me right now. And that's a mentality, unfortunately, that I think is too prevalent in our country, and maybe the world, but more so in our country. I really do think so.
Yeah, that is certainly a big problem politically, which many would say could be solved by term limits, or at least addressed with term limits.
I would love term limits. That would be a huge thing.
But let's focus on what we can potentially make some kind of money on.
Okay.
Right? If you're seeing a pullback with Bitcoin, what are you bullish on? Is it gold?
Yeah, so gold, absolutely. The breakout on gold is huge here, and we'll look at this right now, and we can see how long we've been hovering right up against this level. Right? So we keep on hammering. Since the 2020 COVID run, we've now been hammering on the same level until this breakout occurred. And this is actually, what there actually is here is an inverse head and shoulders that gives me a target. You can calculate a target via an inverse head and shoulders, and it gives us a 2,540-ish price target. So again, that should be achieved in about 12 to 18 months, which again, for gold, that's a huge move, right? I mean, you don't see moves like that in gold very often. One of the reasons I look at that is because if you go back on the chart here, we had the same sort of consolidation here, and we finally broke out. And you can see right here when we broke out, right here. So we kept on hammering. We broke out, and it took about 12 to 18 months from this point to that high. And so you're looking at kind of a repeat performance of that type of situation going up to that $2,500 level. So I think that's a huge one. At least in the short term, I'm bullish on on small caps, IWM, the Russell. I'm bullish on foreign markets. I think that money has been drawn into the U.S. because there's been this, the Fed is the best, the U.S. is the best. I think that actually starting to get hurt. I think between the political turmoil, the geopolitical stuff going on in the world, that more and more people are going to say, wait a minute, I need to be invested in other countries that mainly have resources, right? And I'm not just talking about oil, but I'm talking about rare earths, gold. As those commodities start to take off, like Brazil is one of my favorite charts out there. In fact, let me bring this chart up. There's this incredible chart on the EWZ, right? And again, you can even extend the lines further back, but this is just the weekly chart. But look at this wedge pattern, and then look at recently what's happened. We've broken out on this, and we have not, Brazil has not, at least this ETF has not made new highs since 2008. And remember, Japan took 30 years. And so there's so many foreign markets that have been underinvested in, and that's where I think the money's going to go. And Brazil has a huge amount of resources here. I think that's the future right now, especially as fiat currencies continue to be debased.
Why Brazil as your emerging market of choice?
Well, I think there's a lot of them, right? I mean, there's a lot. But I'm basically, what I did is I looked up online. I did a lot of research on what countries have the most rare earths, the most gold, and other major resources. And Brazil was right at the top of most of those lists for those type of resources. Oil itself, not as important to me, as I do think the U.S. has become so dominant in production that I don't think that the reliance on other countries that just do oil are as big. But again, rare earths is only going to get more important. And again, the climb to see gold breaking out, a country like Brazil or other countries that produce a lot of gold, that's a lot of wealth that they can tap into.
All roads lead back to gold when it comes to Gareth Soloway.
Yeah.
Before we go further into the gold conversation, you mentioned that you're bullish on small caps, which I think is interesting if you're concerned about a recession.
Right.
Why would small caps then do well in a recession?
Yeah, so I think you look at, so this is the foreign markets, by the way. So this chart right here this is the China market as well as the Brazil market. And this is going to lead right into that question that you were just asking. But you can see the NASDAQ is the top one. Look at the divergence. If you go back here, there was almost no divergence in these markets. So again, the idea is that money has been concentrated in the NASDAQ, in the S&P. The Russell has really been lagging here, and it has been underinvested in because all this money has gone towards NVIDIA, towards Microsoft, towards Meta. And my guess is there's going to be this interim period between when we hit a recession and where we are currently, where money starts to be taken out of those because they're so overbought, and people look for, well, where is it going to be? What if the Fed does cut rates? That's so good for small companies, and they're so cheap relatively to some of these larger companies. And I think that's where that money's going to go. But please understand, that's a short-term trade.
Okay.
That's only like 3 months, 6 months out, where I think that outperforms the NASDAQ then. Once we hit a recession, you don't want to be in small caps anymore.
So you see an interim pop in the Russell?
I do. I continue to see an interim pop in the Russell. Again, just incredible how we can see here. I want to show you this chart here as well. This is the Russell 2000, and we've seen this beautiful same thing, beautiful little breakout. And the Russell, again, has not hit new all-time highs. New all-time highs, you have to go back to 2022. So think about the lag on this, and then imagine what the NASDAQ chart looks in comparison. And the breakout right there, I mean, right here on the chart, right there, this is telling me that this has further upside to probably maybe retest its all-time high, which isn't that far, but in comparison, it should outperform the NASDAQ.
What percentage gain are you looking for the Russell 2000 in the sort of short term?
Probably 10 to 15%. So you're looking at 10 to 15%, while I would think that the NASDAQ probably has to retrace a little bit as we start to see some of these bigger players start to crack after they've made such massive moves.
Okay, let's bring it back to gold then.
Okay, back to gold.
Again, you've been calling for gold to hit a new all-time high. We did see it reaching a new record of $2,141 per troy ounce based on the London Stock Exchange. It's interesting, though, because at the same time, we're hearing about outflows from gold ETFs into Bitcoin. I mean, that's been a huge headline, right? That gold ETFs are hemorrhaging money and it's going into Bitcoin. How did we manage to get an all-time high in gold when we have this ETF outflow?
Why? And I think that's the crux of why it's so bullish, is because you have these ETF outflows from retail. moving into Bitcoin. Bitcoin's the sexy thing right now. I mean, it just is. It's where everyone wants to be. You talk to anyone on the street, they're talking about Bitcoin. I've had friends that have people call them up about Bitcoin that have never invested in their life. Oh, I got to get in on Bitcoin. To me, those are signs of tops, not bottoms. And so again, and I'm not talking long-term top, we're just talking short-term here. But again, you look at what the central banks have been doing, buying literally hundreds of billions of dollars in gold and stacking their reserves. And I think that's why gold has stayed so close to its all-time highs, is because there is demand. It's just not from retail investors, but there's massive demand from other governments stockpiling. And again, I think it has to do with the debasement of currencies, is these central banks know that they're going to have to, at some point, turn the printing presses on. They know the good times are now coming to an end. Well, how do you backstop your own, system? You have to buy that gold.
Yeah, because we have had 8 consecutive months of outflows from gold ETFs, led
gold,
by
like you
North
said.
America funds, according to the World Gold Council. Collective holdings of global gold ETFs falling by 51 tons to 3,175.
Yeah,
So
incredible.
And yet we're seeing gold prices continue to climb. You're saying that is all the smartest money. If you're calling central banks the smartest
Central banks
money,
are way smarter than me. And part of it too is whether they're really smarter or not IQ-wise, it doesn't matter. They're the ones that control the systems. So
what does this mean for the much beleaguered mining stocks then?
yeah. So the mining stocks, right? I think the mining stocks are going to outperform massively. And I want to show you this chart here. So this is a chart of the GDX. And we know that the GDX has underperformed for so long. I actually was talking to people that are just like, I'm beside myself. I thought the miners were the place to be. And I'm just losing money in miners left and right. And the kicker is this, is what people have to understand is that the reason why the miners have underperformed for multiple years is because we've seen inflation, average 5, 6, 7, 8, 9% for a couple years now. Even though it's come back down, gold has not gone up, right? So if we let's flip back to the gold chart. What has gold actually done since 2020? Nothing. And so you have inflation jumping, let's say 10%, meaning all the gold miners, their input costs have gone up 10, 15, 20%. They're paying their workers more, their machinery costs more, and they're not getting more for their gold they're mining. And so that's really detrimental to their profitability. And so gold miners have been suffering during this period. But once you get gold to start outpacing inflation, meaning let's say gold goes up 10%, but inflation stays at 3%, now it's gravy for them. They will outperform and have monstrous recouping moves to the upside. So I love the GDX, Newmont Mining. I mean, generally, I'm a fan of sticking with best of breed. So you're looking at the bigger players, the juniors. Lots of people love the juniors. I don't know enough about individual companies to pick those. But Barrick Gold, all of these bigger names, I think that's where you want to be if you're a believer that gold is going to 2,500.
And you're a believer that gold is going to 2,500?
Absolutely.
By when?
Again, we just broke out, so let's give it 12 to 18 months. We'll be there.
Okay, that's not such a dramatic move.
Well, for gold it is.
If
I mean,
12
if it was
to 18
Bitcoin,
months,
no, but for gold, that's a big move, right?
And do you see a new support line for gold right now then?
Yeah, so now this is very important. So since gold broke out above that level and a head and shoulders inverse pattern is broken out, you do not now want to see it come back below that level. You want to see that. It was resistance for 4 years.
So 2,100 is a support level now?
It's a little bit below that. If we put the line here, it looks like it's around 2075. So you want to see 2075 hold now. As long as that holds, it's upside until at least 2,500 and change.
And how much of this is dependent on what we hear from the Fed?
I don't think, honestly, I'm not sure if it's that much. I mean, if the central banks are continuing to load the boat and the retail investor is underinvested, let's say the Fed says, oh, hey, we're going to start dropping rates. I still think it goes up, right? Because either way, if inflation stays high, then gold is the place to be because the dollar, obviously, it's inflation, right? And so gold is the place to be. If they drop interest rates down and they start printing again, it's the same situation, right? So almost either way, I don't see how gold doesn't perform here and have a monster breakout.
Is that your point of highest conviction for 2024, that gold will be the asset?
Oh, man.
Because you've called it correctly before with regards to gold.
I have. I do think so. And listen, that's such a hard thing because, Bitcoin can move so quickly. I think if you ask me in the next 10 years what's the best performer, Bitcoin blows gold away. In the next year, if I'm correct that we do see a stock market that corrects significantly, then I think Bitcoin struggles and gold will be the standout.
What would cause this correction that you're still expecting in the stock market?
So
what would trigger it?
So the trigger is inflation. So we even saw the CPI, PPI numbers get a little hotter. PCE calmed nerves just a little bit. But again, if we see inflation sticking around 3% and maybe even upticking to 3.5 to 4%, and we do start to see a recession emerge, the Fed is going to be handcuffed. Right? They can't come to the rescue of the markets because they know if they start printing with high inflation already, it's only going to go higher by them adding liquidity to the system. So again, that's your case for a big market correction when the market basically gets caught with their pants down and it says, oh my gosh, the Fed cannot rescue us. They can't come to the rescue like they did in 08, 09, or in COVID 2020 or these other periods. Even in 2018, I still remember vividly, the stock market dropped 20% in like 6 weeks, and the Fed was like, we're going to hike. And as soon as it dropped 20%, the Fed was like, no, we're going to cut now.
All right.
And essentially, if we see inflation, the only reason they could do that is because inflation was 2% or under. With it north of 3, let's say, they can't do that because they will create hyperinflation. They will create a scenario of potentially stagflation, which is the worst.
So you're back to that call, which is something you've been pretty consistent about, that the Fed is going to lose this inflation fight.
Yeah, I'm just not a fan of the Fed. I'm sorry. And every which way, I think that eventually we have a system that really is no Fed involved anymore. I think they're going to be the scapegoat when all of this comes crashing down in the next 5 to 10 years. And we'll probably emerge with some sort of crypto-backed sort of system that's stated run of currency. Like again, the currency cannot expand by more than X% per year, no matter what. Balanced budget. I mean, these are all things that are going to have to be done during this reset period. And again, this reset period is over the next 10 years. This is not like a short-term call, but we're on that path to getting to that point.
The Great Reset.
I do think there's a great reset to come. Absolutely.
With a central bank digital currency.
Yeah. And it's scary. It's honestly scary. And again, I don't want to see it. But when you look at what's going on in the underbelly of the economy, if you look at what's going on politically, if you look at all these situations, it's only getting worse. And I worry that AI is only going to accentuate that. Now, AI is great, don't get me wrong. Just like the internet, it will be great in some respects. But I argue that the internet has also been a huge negative, whether it's social media's impact on people's mentality and psychology. All of these things, there's negatives and there's positives. AI is great. It's going to help us in our everyday lives. But you know what? It's also going to kill jobs.
Yeah.
Like you will have millions of people getting laid off. Yeah, there's going to create some jobs too, but not the amount that it's going to be laid off. I've even heard about McDonald's now. They got robots that are now doing all the burger flipping and all that stuff. And so you're going to have this divergence. And we've already seen this, right? Where you have the really wealthy people and then you have the poor people. And that middle class just continues to shrink and shrink and shrink. And AI is only going to accelerate that.
Right, which would pave the way for a universal basic income, which could be very easily distributed via central bank digital currency. Viewers of the show know that if there is one thing that keeps me up at night consistently, it's the idea of a central bank digital currency and what it means in terms of obliterating privacy, anonymity, and any kind of expression, because you could be curtailed and canceled so easily when you're on a CBDC system.
You're right. But I will just point this out is that we're 90% there already. I mean, like, do you use cash anymore?
I personally do, as a personal form of protest,
Okay.
because I'm trying to keep cash alive. So I try to make a concerted effort to use cash.
But most people,
But fair enough.
I would say if you go to the average person, they have very few dollars in their wallet and it's credit cards. And so that's already tracking everything you do. You have your phone on you. Do you have your location setting on or off?
Yeah, no, sure. Everybody's
like we are already in that scenario. It's just, but you're right. It's one step further, and that's where it's all going.
But that's still maybe a decade out, even though we have had Congress making some pretty strong statements against a CBDC, at least on the Republican side.
Right, you know why, right? They don't want the privacy totally because they're the ones that do half the shadiest stuff of all of us, right? I mean, so like...
Valid point. Probably, it has become a political issue. We've had President Trump address it on the campaign trail. It is getting a little bit more political traction and coverage, and at least, at the very least, understanding that this is something that needs to be approved by Congress before it gets passed through. But CBDC's conversation for another time. Do want to bring it back to a slightly nearer term. And one of the things that we're heading towards is the March banking crisis anniversary, right? Let's keep in mind that it was about a year ago this time that we had two of the largest bank failures in U.S. history. Where are you in terms of how the resilience of the banking system looks to you?
I look at the banking sector, especially regionals, as being what's called zombie banks. And what I mean by that is that because we bailed out, well, the government bailed out depositors at Silicon Valley and these other ones, there's now this feeling that, oh, we don't have to ever have a bank run anymore. And what that's done is with the commercial real estate. So commercial real estate right now is way more atrocious than even during 2008, 2009 for the residential.
Yeah.
It is horrendous. But because depositors aren't worried about these banks going under at this point because of the backstops that the government's put in place, they can still operate and be zombie banks. But it is, the underbelly of a lot of these banks is not good. And again, what's crazy about this is I still remember vividly, and I've traded for way too long in my life and been an investor, but after 08, 09, it was all about we can't have banks being too big to fail. Well, guess what? The banks have only gotten bigger. And you know what? Now we have companies that are too big to fail. You think they'd ever let Apple fail? You think they ever let Microsoft fail? No way. And so you're creating, again, this monopolistic society where these players have so much control. And again, this is not to get back to political stuff. And I really try to stay right down the middle of the road. But think about the influence that a company can have on the politics of the scenario.
Sure, yeah.
I mean, it's massive. And so people just have to realize, open your eyes. So many people are like, oh, well, I don't want to know about it. Just, all right, well, put your head back in the sand. But I at least want to know all. That's my job as a trader, is to look at all risk possibilities and plan accordingly. And if nothing happens, then great. I live my life and I'm just like, great. I'm glad I stockpiled some gold. I'm glad I have this. I'll pass it down to my kids, no problem. But if something does happen, I want to be prepared.
What do you say to the idea that, again, some of our viewers call you Gareth, not Gareth, that you're a perma-bear?
Yeah. Well, and the answer is that right now I am. But at the same time, in 09, I was buying hand over fist bank stocks. You can, again, there's even track records of this going back that far. But again, for me, I am very concerned about what I see. And I see cycle work. I do a lot of cycle work with markets and with cycles of the economy. And I also see what the Federal Reserve is doing. And then literally I go home. Literally what I do here is I finish my work in the office, which is all trading and all studying. I go back, I put the kids to bed, and then I go right back into bed, put my laptop on my lap, and go right back to studying all this stuff. And it's not a pretty picture. Right. And so listen, people do have to understand I'm a swing trader. So literally, if we drop 10% in the markets, I'm buying stocks, but then I'll sell them when they pop and I'll go back looking to short again and I'll just play it back and forth. But when you talk about the bigger macro view, dang right, I'm Gareth. I will own that name, because what we are doing here as a country, as a world, with GDP, debt to GDP ratios, and China everyone's all about just print this modern monetary theory crap. Mm-hmm. It's not sustainable. And people, we have to understand we're going to have to pay at some point. You just pick your poison. When do you want to do it? Do you want to print another 20 trillion and just push it off another couple of years? Or do we want to deal with this problem now?
Well, Gareth, one of the big themes that our guests have been echoing is expect the unexpected for 2024, that anything is likely this year, especially it being an election year, especially with so many geopolitical flashpoints in the world, from China, Taiwan, Russia, Ukraine, Middle East, Iran, Israel, Gaza, that there's so many potential flashpoints that trigger an escalation. Mm-hmm. And that expect the unexpected is the biggest theme for 2024. I'm not sensing you're going to have anything positive to say on that one, Gareth.
So I think, you always have to be aware of what's going on geopolitically. I just saw the other day that China removed language that they moved to language much more adept at potentially being militarily involved with Taiwan. That was something that kind of piqued my interest, because again, I sometimes have some positions that are in China. And I learned the hard way when Russia invaded Ukraine, the Russia ETF collapsed 80%. And I was like, man, I'm sure this will be a month-long thing and I'll make so much money. Didn't. They actually halted the ETF. I ended up losing everything on that ETF. Luckily, I'm a diversified investor. But I learned from that, and I have to be very careful about China and potentially the Taiwan situation, even though I think the valuations in China are incredibly attractive. But again, going into 2024, yeah, I do think investors need to be ready. People seem to think that the markets can only go up, that every little pullback is a buying opportunity. 2% pullback, let's buy the markets. It doesn't work that way. I've seen these bigger moves, and they will come again. There's only so long it can be pushed off.
But despite being bearish, or even because you're bearish, you're still making money, right?
Yeah,
because as
of
a
course.
swing trader, you take advantage of daily price moves.
That's right.
And that's what you teach in the Verified
right.
Investing course.
And that's the beauty of it, right? Is that what I teach in the Verified Investing course is how to read charts. Charts, again, intraday, they can be bullish, they can be bearish, and there's even opportunities on the long side on swing trades and on the short side. There's never a lack of opportunities out there. I mean, heck, there's gold miners on the long side. Now, again, right now, I think stocks are too high, but you give me a pullback into, let's say, 200 daily moving averages or major pivot support, and you start buying. And that's what I've been able to do in my career, is to play both sides of it, meaning go long when the charts are telling me to do that, and then go short when the charts are telling me. It's just in general, the public always wants to go long,
right.
And so I get this moniker of, oh, he's always bearish, because they always hear like, that's the one. When I say I'm going long, they're not like, oh, that's a shock. No, they're like, oh, he's going short. That's the shocker. But that's just the way it is. And you're right. The course that I did is everything that's up here is in that course. And like this is the legacy I want to leave. I want to let people be able to avoid the pitfalls that I've made. I lost so much money early in my career just making such stupid mistakes. I look back on it and I'm just like, what the heck was I doing? But there was a road to learning what I've learned. And that's all in the Winning Trader series.
So give us an example of a recent trade that you had that turned out well for you using your chart analysis system.
Yeah, so just in the last couple days, closed out some gold miners after they just came into major technical support. Again, Barrick was one of them, came into a major technical level. We saw about a 10% bounce there, booked that. And then also these other levels, like for instance, you mentioned the short on Bitcoin at the spot ETF. I mean, that was a classic 618 Fibonacci retrace. I talk about that in the course. It was also a major pivot high. The idea of charting is that you want to find multiple factors within that chart that align at the same price point. That increases your probabilities of success, probably 70 to 80%. And so when we got that 20% pullback, I was short Bitcoin then, but you know what? I covered my short. Now I've been on the sidelines, and now I'm re-shorted Bitcoin at a much higher level. And I found that by doing that, I can make way more gains than if I just buy and hold.
Right.
Like, because I'm playing the ups and the downs and the ups and the downs, and it's pretty cool like that. And I that's why I like teaching people, and people come to me, they want to learn this stuff and basically take control of their finances. Instead of just hoping that we don't have another 08, 09 and they lose 60, 70%, take control of it.
Right, and that's the strategy. Make smaller time frame trades,
right,
and book those gains as they're happening.
Exactly.
Based off the charts.
Yeah, exactly. And then essentially the reason why too you want to be a shorter term investor is because as you start learning the charts, you start to see the potential for these bigger drops. And I still remember, I knew people that were going to retire in 07, 08, 09, and they lost so much money they had to go back to work. And I remember that stuck with me, and I'm like, I don't want to be that person. I want to be seeing it in the charts. Even if I'm in cash and it still goes up another 10%, at least I'm not giving back 60, 70, 80% of what I've made in the last 10 years.
All right, here's your plug moment. Where can people find the course?
Just come to verifiedinvesting.com. And by the way, we're launching the new website very, very soon. And verifiedinvesting.com is not Gareth Soloway. It is a place that we are putting the best investors and traders that are going to give out the best information. Like, I want this to be a place that people can come, and when they come here, they know that whether they want to follow me or someone else, they're getting quality, and they can follow verified track records, and that they have that trust behind it. So that's really the dream that I've had. It's the legacy I want to leave.
To empower other people
to
pursue and gain financial freedom.
That's it.
It's a great dream. Glad we can hear more about it. And thank you for having me here in Florida, because it's always a good excuse to come and hang out in this beautiful state and enjoy the weather and enjoy the insights of Gareth Soloway. Thank you very much.
Thank you so much for coming down and seeing us here at Verified Investing.
And we'll get a lot more content from this visit. But for now, we'll wrap it. As always, thank you all for watching. I'm Michelle Makori. For me and the rest of the Kitco team and the Verified Investing team, thank you so much for watching, and we'll see you next time.